Unit 4, Risk and Return, Lecture 10, Portfolio Performance Measurement, Part C. We're now moving on to portfolio performance measures, in other words, how the performance of a portfolio manager will be evaluated. And actually, there are two major components when looking at a portfolio manager's performance, and that is related to active management. That means using their skills to generate above average returns by either timing the market or having incredible expertise at security selection. And the second one is about diversification, eliminating risk by diversifying their portfolios. We're going to start by looking at returns. And the two common ways to measure average portfolio return is either time-weighted rate of return or money-weighted rate of return. It is imperative to keep in mind that at all times returns must be adjusted for risk. A time-weighted rate of return is a geometric average of the returns that have been generated over the performance period. Each period's return, as we know, has an equal weight. When we look at money-weighted rates of return or internal rates of return, then the returns here are weighted by the amount that is invested in each period, as we can see from the cash flow formula below. So as always, I think the most effective way of demonstrating these two concepts, or the calculation of money-weighted and time-weighted rate of return, is using an example. So the example we have is that you, at this point in time, have decided to buy a share which is going to cost you $50. In a year's time, you're going to buy the same share, but now the price has gone up to $53. What you're going to get from this share is a $2 dividend in the first year. And because you own 2 shares in the second year, you will receive $2 per share, so you get $4. And at the end of the second year, you are going to sell these 2 shares for $54 each. We're going to start by calculating the money-weighted rate of return. And to do this, we're going to start by drawing our timeline. And as you can see, at time 0, or now, you have a $50 outlay because you have bought a share for $50. You'll notice at time 1, which is the end of the first year, you again have an outlay for buying a share, which is $53, but you've also received $2 in dividends for the share you own. And at time 2, the end of your investment horizon, you've actually received $4, which is $2 in dividends per share for the 2 shares you own. But you've also sold those 2 shares now for $54 each. So when we look at our calculation, you've got an outlay of $50, and your cash flow in your first year is actually $51 or minus $51 because you outlaid $53, but you got 2 in dividends, so the net effect is an outlay of $51. And then finally, you receive $112 from your sale and dividends. And doing your internal rate of return calculation, using your financial calculator, your return is 7.117%. And the reason it is money weighted is because the stock's performance in the second year, when 2 shares of stock are held, has a greater influence on the average overall return than the first year return when only 1 share is held. When calculating time-weighted rate of return, we will invariably divide up our performance period into sub-periods. In this particular example, we have a 2-year performance period, which we will subdivide into 2 one-year periods. And for each 1-year period, we will calculate a holding period return, and we will use those holding period returns to calculate our geometric average or time-weighted rate of return. Now, in our first year, we bought a share for $50, which appreciated to $53. And over that year, we received a $2 dividend. So overall, we generated 10% return. In year 2, we generated only a 5.66% return because our $53 share only appreciated to $54. And even though we got a $2 dividend, it wasn't all that much. So overall, we generated a 7.81% return. The money-weighted rate of return is less in this case than the time-weighted rate of return, because when we calculated our money-weighted rate of return, although we invested more money in the second year, the return generated in the second year was lower than that generated in the first. So in deciding whether or not to use the money-weighted rate of return or the time-weighted rate of return to evaluate portfolio performance, it depends on whether or not you have control over the timing and amount of contributions to the investment portfolio. If, as an investor, you have complete control over the timing and amount of contributions to the investment portfolio, then the money-weighted rate of return is a much better measure to use. The time-weighted rate of return is more appropriate to judge performance when you don't have control over the timing or the amount of contributions, and that's why we would subdivide our performance period into sub-periods, because we would break them up at the points where we had contributions or withdrawals from the portfolio. Now, in the previous performance measures that we talked about, although we mentioned that we need to adjust them for risk, we didn't explicitly adjust them for risk. So now we're looking more specifically at risk-adjusted return measures. So the simplest way and the most popular way to adjust returns for risk is to compare the portfolio's returns with some benchmark. So a benchmark which is similar to the mandate or the way that your portfolio is constructed and managed. The first risk-adjusted performance measure that we're going to look at is the Sharpe index or Sharpe ratio. And this ratio looks at the excess return generated on the portfolio over and above the risk-free rate and compares that to the risk taken by the portfolio. Now, what's important to note is that the risk measure used here is standard deviation on the portfolio, so it's a total risk measure. And so the Sharpe ratio looks at the excess return per unit of risk that has been generated. And you want this number to be as large as possible because that indicates that the returns were generated without taking excessive risk. So it actually alludes to the skill of the portfolio manager. The higher the measure, the more skilled the manager. Lower the measure, the more risk taken in order to generate the return.